Hello, thank you for joining today. My name is Dave Mantell, and I'll be your presenter. And as we embark on 2024 and have an election coming up, it becomes an especially important year to make sure you have the right investment strategy. These two factors alone, investing and preparing for retirement while you're on that home stretch, as well as investing and weathering the market volatility of an election year, alone, each of those factors can be overwhelming. And when you combine them together, the stakes feel that much higher. And so in this presentation, we'll go over, for those that are approaching retirement, how to take on investing in an election year, especially one that has very high stakes and emotions surrounding it, such as the elections in 2024. So as I share my screen here and we dive into the presentation, we're going to cover three main keys in terms of approaching an investment year, an election year investment strategy. And in each of those keys, we'll break down certain things and activities you can be doing to set yourself up for the best chances of success. And with that in mind, we'll look at some of the unique challenges of investing in an election year, both the volatility, the historical patterns that come with it, and really equip you with all the tools that you need to take that on directly. So as I noted, in an election year, there's a lot of unique market dynamics, and much of it is the emotion as much as the X's and O's and the actual response that the markets have. As we know, markets do not like uncertainty, and there's nothing more uncertain than taking on elections, especially with the current components in play. And so when you approach a market year, it's really important to be dialed in, not just in terms of strategy, but also the emotions and how you approach it and the actions that you take, because that's really going to be the number one driver of having successful results. So if you're feeling the angst of the elections coming up and what's the stock market going to do, you are not alone. So year over year, as we come along election years, they typically do come with market uncertainty and investor uncertainty in response with that. So as you can see here, going back to 1992, we could see each year of a 4-year US presidential election cycle and how investor behavior has varied year to year. So if we look at year 4, which is the far right end of the screen, this is a presidential election year, the 4th year of that election term that we're sitting in today. The dark blue line shows net investment into equity funds, so stock market investments. And so generally when people have positive views of the economy and the stock market, expect good results, optimism, that dark blue bar tends to be much higher, as we see in the other years. In the final year of a presidential term, the election year, you could see there's a lot more angst and uncertainty. And as a result, it's the least amount of annual investment in the stock market that you see in any of the 4 years of that term. The more lighter blue teal type of bar, that shows flows into money markets, cash, conservative investment types. And you could see year 4 along with year 3 of the presidential term, the back half, that's when you have the most angst, the most investors seek certainty, putting cash on the sidelines. And so typically that 4th year of the term, the election year, that's when you'll really see folks kind of hide for safety and try to get into that more sure thing. What's interesting is then as you turn the page, so let's move from year 4 of the term to year 1. So once the elections are over, that's a far left year on the chart. Once we have that certainty of we know who is elected as president, what's going to happen in terms of where that all lands, what the goals of that presidential term will be, you can see with certainty comes confidence. And that really flips where that dark blue bar, the investments into the stock market, kind of a more high risk, high return type thing, really skyrockets. And so it's really typical when you generally see an election, cycle, that last year of a term going into the elections, there's a lot of angst, uncertainty, looking for the more sure thing. But when you notice right after the election happens, typically you'll have a strong result in the market pretty commonly, and you'll see investors open up again. So by entering the election year with a plan, with a strategy, with confidence, you could really skip that anxiety step and take advantage of what could typically be pretty strong market periods, following an election, by being a little bit ahead of a ball and letting your approach and your logic guide your investment decisions versus a lot of the emotions and the uncertainty of the markets. And so bottom line, investors get nervous and move to cash in election years. It's really typical, but that's rarely a winning strategy. And by going in, with kind of a more proactive approach, you could stick to your guns, stay on schedule with your own investment, strategy, and come out of the elections typically a bit stronger than your counterparts. So we went over investor behavior and emotion and what that looks like. And that leads into, okay, what do the stock markets typically do in election years? How do they historically fare? And what's really interesting is I hear all sorts of things. Depending on which neighbor you ask or which colleague at the office, you may hear election years are great years to invest. The incumbent candidate wants to amp up the economy to kind of drive up their stock, going into the elections. Likewise, your other neighbor may say, wow, no, election years are incredibly volatile. There's a lot of uncertainty and angst, and it makes its way into the markets. And so we will shine a light on the reality in terms of what the market does in an election year. And you can see for yourself what the true result is. Before we go into that, there are a couple unique elements that we're dealing with currently. And there's much political division in play. And we'll see what the market implications are as a result of that. So first, as we noted, we are in an election year that comes with angst. And more than ever, we're seeing a lot of divide between the Democratic and the Republican Party. And so that definitely has played into the fever pitch of anxiety, not to mention the media attention surrounding it. On top of that, there's much geopolitical tensions going on right now and uncertainty. And with that, between the two wars outstanding in the Middle East and Russia, Ukraine, that does add another layer into some of the market impact that we're seeing. And also a key component in terms of how each candidate, positions themselves, with those geopolitical views, really can have an impact this time around. And then lastly, we see that ongoing question, are we coming up on a recession, or is this going to be a soft landing? It'll be interesting. We've seen that recession call going on a couple of years now, and it's yet to happen. And so, some folks are sticking to their guns and saying, hey, it's just a matter of time. Others are saying, oh, we've moved on to a soft landing, inflation's at bay. The reality is we're going to have a recession at some point. They typically happen every 5 or 6 years and are very normal. Whether that happens this year, next year, in 5 years, time will tell. The biggest factor with all of this is going to create media attention, eye-grabbing headlines, and anxiety. And the reality is nobody knows how any of these factors are going to go. And it's impossible to position a portfolio with a crystal ball in mind because there's so many different outcomes. The main thing is that over time, the market does tend to weather and adapt really well. The question is how investors are able to stay on plan and stay on their seat with all the news, media magnification, the headlines, the uncertainty, because there's going to be no shortage of what the media can grab onto. And so the one thing for sure is there's going to be volatility this year. There's going to be headlines, there's going to be anxiety. But the main thing is to discern what matters for your investment portfolios and what you can proactively control, controlling those controllables, versus what's going to be more fear-mongering, anxiety-driving, but not something that you can constructively control or react to. So before we go into how the stock market reacts in an election year, it is important to shine a light that 2024 is going to be a historic election year, not just with the US presidential elections, but around the entire globe. And so when you go country by country, each different nation has its own election schedule. Some are every 4 years. There's some elections that are every 2 years. Some occur every 5 years. But the stars have really aligned where in 2024, you're going to see a massive amount of elections with more than half a world's population potentially voting this year. And that could be, 4.4 billion people, billion with a B, voting around the globe in 2024. And so, as we noted, the market does not like uncertainty. That is not just specific to the US, right? That happens with the world's global markets. And so, with the amount of elections and changes that could be in place, that is at a fever pitch, the amount of, accentuated volatility tied to the unknowns of all these voting outcomes. And so, it's not just the US, our counterparts around the world also have a lot of buildup and unknown and uncertainty. And so that does create that much more potential range of outcomes when you account for all the elections around the world. So, as I alluded to earlier, we get the question all the time, what does the stock market do in election year? Is it a really good year? Is it a bad year? We've heard it's amazingly volatile. And the answer is there are some unique factors to the stock market during a presidential election year. But in total, the market tends to, return pretty similar results to what it does in a non-presidential year. And see, as you can see in the chart, the dark blue line, the higher of the two, that is a US stock market S&P 500 performance throughout the calendar year, January through December, and then on into May in a typical non-election, cycle year. The lower lighter blue line, that is an election year stock market result. Again, starting with January through election day and the early months, following the result of the election. And so the reality is going all the way back to 1932, they are pretty similar results when you give it a full, years plus worth of time. In an election year, the market does tend to lag slightly. However, the entire year, you have to break it up into two parts, really. So in the first 5 months of an election year, typically, you tend to see the market lag a bit. And that's as we get through the primary sessions of the elections. And it makes sense, right? The market tends to not like volatility. And as we're sorting through who the primary candidates are going to be, we see the posturing and the positioning. Generally that initial run up in the first 5 months of a year, the market tends to be a bit more volatile and lag a bit in those election years as it's working through who's going to be, the primary candidates that make their way through. Once we reach that, May, June period on average, then we typically see the stock market tick up and catch up to its general non-election year as we get some certainty in terms of who the candidates are and, see as the market starts to get its footing a little bit. And so it tends to be a pretty strong balance in the second half of the year as a result of that, as markets, again, tend to like some more certainty. The reality, though, is that for investors that have stayed the course, it works out over time. Going all the way back to 1932, we've seen that the stock market has gained over 11% in the 12 months following the conclusion of the primaries. So again, once we work our way through that end of May period, essentially, the stock market tends to perform really strongly on average in that next 12 months. And to remember, every year is different, right? Somebody who went into this year saying, I'm going to sit out the first 5 months and then jump in after the primaries are established, missed a really strong January, February market performance so far this year. And so long story short, for a patient investor that sticks to the plan, generally an election year comes out pretty similar if once you let it play its course and get into the year prior or the year following, starting from the year prior. And it could be really challenging to try to time, what's going to happen. And so by sticking with your guns and weathering the period, as you let it play out, your investments will tend to do very similar to what they typically do, which is generally quite strong. So as we've looked at kind of the investor behavior and then stock market behavior and invest in election years, now we can move into some critical steps that you can take as you prepare for an election, especially as you're approaching retirement or retired for that matter. And as I started out with, when approaching retirement, the stakes just get a bit higher. When you're taking money out of your investments, it's an added complexity. When you're working and saving and putting money away, you have a lot of time for your investments to recover from volatile stretches. And on top of that, by adding money through your paychecks, you have the chance to be buying low as you go along. As you get closer to retirement and transition to retirement, and you get closer to that period where you're taking money out, it adds a level of complexity and those higher stakes that I noted. And so it's just really important to go into any year, but especially an election year, with a ironed out game plan on how to approach it. So you have a strategy and a winning strategy that can get you to the finish line. And the first step when investing in an election year, especially as you're getting closer to retirement or retired, is investing according to your personal time horizons. And what that means is it's so critical to align your investment portfolio with your own needs. What that means is as we get closer to retirement and into those retirement years, and you look at all of your portfolio of investments, every dollar in your portfolio has a different job and a different task at hand. Some of that money is going to be funding your early retirement years as you're having to take out withdrawals and retirement paychecks. Some of that money you're not going to be touching for a long time, 7, 8, 9, 10 plus years even. And we need that money to keep up with inflation, be there for future unforeseen emergencies or expenses, whether that's long-term care or helping family down the road. And so every dollar within your portfolio and your savings has a different mission. When we get into retirement, your income consists of Social Security at a certain point. If you have a pension, you may have some pension income there. And then the remainder is draws from your 401ks and your investment accounts and savings accounts. And therefore, it's really critical to tailor those investments to your personal income needs. And the best example I've seen for this is, let's just say you have a coming expense in the next year. You know that you're going to have to replace your roof and you need $20,000 to do so. With that money, that $20,000 that you're earmarking, you don't want to put it in something that can be down quite a bit over that period, right? You want something that's certain. Yeah, it'd be nice to earn a little bit of income on it, a little investment return, but you need that $20,000 to be there when you need it. The same thing applies for retirement income. Money that you need in year one of retirement, you want in something steady, Eddie, income oriented, where it's going to be there when you need it. Same thing applies for money you need in year two, in year three. And so as we get further out, we have more time to give your investments to recover. But money in the short to medium term, we need that to be a more closer to a more sure thing, right? Where you're not taking as much risk and you're giving up higher return, but with that, you're getting something that has more income certainty attached to it. So the good news is that when investing, going into election years, over the long term, going all the way back to the early 1930s, the US stock market has nearly always been higher at the end of a president's term in office than it was at the beginning, regardless of a party affiliation, whether a Democratic or Republican candidate. And so it's pretty eye-opening to see, no matter which way the election went, the stock market has tended to make progress each term, despite that presidential outcome. And so going back to 1933, if you had $1,000 in the US stock market, that would be over $20 million today, 1,000 to 20 million. And that has been over many Republican candidates, Democratic candidates that have won office. And so despite that, we've seen nearly identical returns no matter who's in office. For example, going back to 1930s, for Democratic candidates on average, we've seen just north of 11%, during those Democratic terms. Same thing for Republicans on average, just north of 11% over those Republican terms per year. And so the key here is don't make an investment decision based on politics. Either way, we tend to see the market weather no matter which candidate was in office. Pretty amazing example is if we rewind back to the start of 2009, coming off of the 2008, Great Recession, where, we had Obama being elected. Many may say, oh my gosh, we have someone that's taking more of a community organizer approach. What's the stock market going to do in this scenario? And for someone that sat out or, was leery investing into that presidential term, you may have been smart for about 6 weeks, but you would have missed out on a 12-year stock market bull market, right? An amazing, one of the best periods in US stock market history. Likewise, when Trump was elected in 2016, someone worried about how the market would respond, what would happen, they would have been smart for one day. And then after that, the stock market came on really strong, and it was a really strong presidential term, despite that. And so, it's important to remember that no matter which candidate ends up winning, the market tends to persevere. And by having the tools to be set up where you could stay in the market, let your stock market investments be long-term and do their thing, has tended to be the winning strategy versus trying to, predict, what the market's going to do in that period. Okay, so after that first step of making sure you're matching your investments to your time horizon and allowing your long-term investments to therefore be long-term investments, the next step is how do we prepare and handle volatility? As we talked about earlier, especially in the first half of the year during election years, we do tend to see a bit more volatility. And when you're looking at things on a monthly basis, such as a top chart here, you can see the fluctuations month to month tend to look very dizzying and very dramatic when you look at it over those shorter periods, election years especially. When we look at longer term periods, though, the market performance chart tends to look a lot more smooth when you iron it out over years rather than months. And so this just goes to show by having a plan to not react in a negative way or an adverse way to short-term market volatility is really critical. And so as we do tend to see pretty high volatility early in election years, there's a couple key tools that will really help you end up on top. The first one is strategic rebalancing. So what rebalancing is every investor should have a game plan in terms of how their portfolio should be invested. That includes how much in conservative investments, how much in moderate, how much in growth, and which account you should be doing what. As we go through volatile stretches of the year, where either the stock market outperforms or underperforms, you'll tend to see your investments tend to drift a bit from what that strategic allocation is. And as they tend to drift and your stocks either grow faster than your other investments and get overly large, or as we go through periods where the market's down a little bit and your stocks are underweighted, that could be a great time to rebalance your account back to the target allocation. And what this does, it's a built-in mechanism to essentially buy low and sell high. When the stock market goes on a nice rally and your stocks really appreciate, that's a great time to sell some of the gains, refill your conservative investments, and basically sell the stocks high, to trim the stocks high to get back to your target allocation. Likewise, if we go through a sizable market drop and your stocks have dropped more than your conservative investments, which may have held on really strongly during that period, that's a good time to buy the stocks to get back to the target allocation, and you're buying at a lower price, right? Buying low, which is what the goal is, of course. And so strategic rebalancing during big market swings can be a great way to take advantage of that. Another strategy, especially if you're not retired yet and you're still in your working years, even those approaching retirement, dollar cost averaging is a great mechanism to cut through volatility. And so what that means is if you're investing like clockwork every single paycheck, even if the stock market drops, what that means is your next paycheck, you're buying lower, right? It's a way to buy low. And so dollar cost averaging, again, we suggest talking to your financial planner about this, but that could be a great way to possibly invest your new contributions in a bit more growth-oriented manner rather than your overall current portfolio, which should be in your right mixture for you. And what that allows, again, is if the market goes through a drop, you're buying in lower on that next paycheck. And then you could rebalance as we go through, highs and different stretches. So it's a great way to, again, built-in mechanism to buy at a lower price as we go through drops and cut through the volatility. Okay, so after talking through those strategies and personalizing your investments to your needs and picture, having a game plan to manage volatility. The third bucket, and when we talk about controlling the controllables, this is really at the top of a list, is how to maximize after-tax returns. And so as we have elections coming up, it's important to highlight that we have a lot of scheduled tax changes that are set to happen in 2026. And unless we get, basically Congress and the presidential parties to all be in alignment, we're likely to see some big tax changes in 2026, even if nothing's passed, because we're going to sunset and revert to the prior tax law rules before the 2016 changes that went into effect. And so some of the scheduled changes that we're going to see is, a change in the tax brackets. Many folks, for example, that are in the 24% tax bracket now, maybe in the 33%. We're going to see the lifetime gift tax exemption for federal purposes cut in half, which could be a massive change for many. We're going to see changes in charitable and standard deductions, charitable giving deductions. So there's numerous tax law changes that are scheduled to happen. And so this year and next year, 2024 and 2025, are critical years to really take advantage of the current tax rates and the current tax laws. And what that will allow you to do is if we do see tax changes in 2026, as currently are expected, you will have done the groundwork to take advantage of a prior tax regime. And then in 2026, you can pivot to how do you position yourself to control for the new tax laws. And so it could be things like, Roth conversions at a lower tax rate in retirement, leveraging your after tax and Roth contributions in your 401ks and savings, realizing capital gains at a lower capital gains rate. So there's a lot of personalized strategies that you can do specific to your picture that can really move the needle in terms of setting yourself up for not just tax savings this year and next year, but setting the table for lifetime tax savings for you and your family. And so this could be really specific to your own position. And so something we really encourage you to chat with us on in terms of what can I be doing now? What should I be doing now before the clock runs out to take advantage and position myself for possibly, tax law changes in a couple of years down the road. So that's something that you don't want to wait on, of course. And, with that, really the key is we want to be building a lot of tax diversity across your account types. And so we hear about diversifying your investments a lot. That could be having global stocks and large company and small company. Tax diversity is different. In your pre-tax 401ks and tax deferred accounts, the way those work is when you put money into a pre-tax traditional 401k, you save taxes up front. You don't pay tax while it's in there, but when it comes out, every dollar's taxed as ordinary income. The Roth is almost the opposite, where money that you put in doesn't save you taxes up front, but all the future growth is tax-free. And so it's really critical, in these current tax laws to try to build up some nice diversification across these buckets to give you flexibility in the future. Another key on top of that is making sure as you build up these different types of tax buckets, how do I make sure I'm holding my investments in the right location to maximize on that? A good example is for some of your growth stocks, for example, where you expect those to go up a lot over time. As that has time to grow and kind of accumulate. A good place to have that is where you don't pay any tax on the growth, like a Roth account. A traditional IRA 401k, where you pay tax on the growth when the money comes out, but you don't pay tax on any of the income in there. That could be a great place for your higher income earning investments. And so as you build up this different tax diversity of those buckets, and that next layer is making sure you're investing in the locations to really take advantage of that. So as we've gone through, just like those other steps, taking advantage of the current tax rates, having an eye on what changes are supposed to happen and when, can be a fantastic way and a third step to set yourself up in this election year and position yourself where no matter what comes down the pipeline, you're in a way to weather that and position yourself to take on whatever is ahead of us, no matter what that may be, right? So a bonus item is we constantly see folks that may have high concentration in a single stock. And especially going into an election year, having a plan to diversify stock concentration, whether that's Boeing or Microsoft or another stock, could be really critical. And as we've seen, when you go through elections, you could have a range of outcomes, especially as there's changes in policy, whether that's on climate change or taxes or whatever it may be. And as a result, as we go through election changes, that can result in a big difference for specific companies, whether it's favorable or unfavorable. And remember, it's not just what that stock does that we're comparing it to, but it's what it does versus other investment options. For example, Boeing, has been up and down quite a bit recently. And while it's hung at close to $200 for quite a while, it's not just, well, it's still at 200, I'm okay. I've been hanging on to it, but it hasn't hurt me at all. Because the reality is the US stock market, such as the S&P 500, has made a ton of ground and growth over that period. So it's not just what that company does, but what it does against other alternative investment options. In addition to that, if you have a great retirement path, you've done the hard work, right? Now we just need your investments over time to perform as we need them to and perform as they historically have set up to do. We don't need them to outperform or, beat the market per se. The important part is having the right amount of growth and getting the market returns that you should be and need to be getting. And therefore, whenever you hold an over concentration in one company stock, yes, you may get a better outcome if it outperforms, but likewise, you may get a worse outcome that takes you off course and puts your retirement in peril if it underperforms. And so a lot of retirement planning is planning for a range of outcomes that gets you to the promised land, that meets your goals. And so when you have too much concentration in one company stock, yes, it could work out well, but it could work out the other way. And that upside risk isn't worth the downside if it means putting your retirement at jeopardy. And so I'm not saying someone that has a high concentration in Boeing stock should fire sell it tomorrow, but I do think it's important, and we do as a firm, to come up with a game plan on what the target amount of holding is there and what steps you're going to take to get there if you're over allocated at this point in time. So, so as we're approaching election year, I hope that breaks down on those key items and takeaways to go off of. Again, matching your investments to your needs, managing volatility through strategic rebalancing and dollar cost averaging, and having a tax plan to take advantage of current favorable tax rates, as well as looking at over concentration in stocks. A little bit about us. So as many of you know, we specialize in working with Boeing employees and retirees, and we're here to help prepare for that transition to retirement, be there to make sure that transition goes as intended, and then, continue to manage and have a comfortable retirement. And so we have an experienced team of certified financial planners, CFPs. We are fiduciaries, and we help work with Boeing employees and other corporate employees to make sure all the hard work they've done results in a successful transition and comfortable retirement, given the higher stakes and complexities that come with that. And we're really focused on a personalized service and care that helps drive better outcomes for our clients. And so you can find more at our website, planyourboeingretirement.com. And so for everybody joining, we really encourage you to take us up on a free second opinion to look at your investments and retirement plan with one of our certified financial planners. Again, there's no obligations or commitment. This is what we do every week, every day. And so we're here to kind of give you a second opinion, give you feedback, and just talk through any questions or concerns that you have regarding retirement. And then we could see as well if it's a mutual fit for us to help you with those, or if we could just point you in the right direction and give you some great feedback to set you up to get some better outcomes yourself. And so really easy to sign up for that. So what you can do is go to planyourboeingretirement.com. That takes you right to our website that tells you more about us. And there's a big button in the top corner that says Let's Talk. And so if you click on that, you could schedule an introductory Zoom or phone interview. And what this is this will set you up a time with me where we'll talk about, kind of what's important to you, what some of your needs are, and kind of what your financial picture looks like. And that will allow us to kind of go over what information will be helpful as we move into that 1 hour complimentary planning session. So again, no obligation, none of this costs anything. We're here to help and see if it's a mutual fit for us to work with you. And at a minimum, provide some fantastic feedback to get you in the right direction and make sure you're making those smart financial decisions for yourself. So encourage everybody to take us up on this offer. We've done this with many, many folks and just have had some great outcomes as a result. In addition, we're going to keep holding these ongoing webinars and in-person seminars. And so we would love to hear from you on key topics that you would like us to shine a light on and cover. And then also, it would be good. We get a lot of positive feedback on this webinars, but I've had more and more people start to ask about doing in-person sessions where we could really do a deep dive, roll up the sleeves, and connect really well on some in-depth retirement planning topics for Boeing professionals. So go to our website and contact us through there. And we'd love to hear your feedback on what different topics you'd like to see, but also if you'd like us to do an in-person session here soon as well. So again, really appreciate you tuning in. We hope you found this presentation helpful and empowering going into some of the uncertainties with an election coming up. And the good news is that you don't have to go it alone. So please take us up on these offers. We'd love to talk with you and see how we could help out. Thanks again for tuning in. Looking forward to connecting with you all at a later date here. Take care.